All right, in this video, we're going to discuss the liquidity test that Fannie Mae requires whenever K1 income has not been distributed to the borrower. So it's been earned but not distributed. And we can see here in the guidelines, looking at the borrower's proportionate share of income or loss, that a cash flow analysis should consider only the borrower's proportional share of the business income, taking into account any adjustments to the business income that are discussed below, so that the business income can only be used if the lender obtains verification that the income was distributed or that there's adequate liquidity to support the withdrawal of earnings if the Schedule 1 did not show that the income was distributed. And there are two methods that the lender can use in terms of a liquidity test. One is a quick ratio, and it's more appropriate for businesses that rely heavily on the inventory to generate the income, because this test excludes the inventory from the current assets in calculating the proportion of current assets available to meet current liabilities. And then there's a current ratio, which is more appropriate for businesses not relying on inventory to generate income. And that ratio, just as the ratio above, divides current assets by current liabilities, and usually a result of one or greater. So if there's more current assets than current liabilities, the business is assumed to have had sufficient liquidity for the income distribution. What Fannie Mae doesn't really discuss, though, is when the business has to show liquidity. So if we have a borrower that has filed their 2018 and 2019 tax returns, and now we're looking at evaluating their income in 2020. When we look back at 2018, if there was no liquidity at the end of that year, I think logically we would not want to include that income. And the same for 2019, if there was no liquidity at the end of that year. Now, if there was no liquidity at the end of 2018, but there was at the end of 2019, then I think it would be reasonable to count the income from 2019. And if 2 years of tax returns are required, then you would look to divide the 2019 income by 24 months. Of course, the whole reason you were looking back at 2018 to begin with was because they needed to show 2 years of tax returns. If they only needed 1 year, you would only look at 2019. But where the wrinkle comes in is that the feedback that we've gotten through many underwriters after speaking to Fannie Mae is that if the liquidity test is passed at the end of 2019, that is sufficient to count both the income for 2018 and 2019. And in fact, even if the business does not pass the liquidity test at the end of 2018 or 2019, but it passes it through a CPA prepared balance sheet during 2020, that Fannie Mae is allowing the income for both 2018 and 2019 to be used. They're saying that if there's current liquidity, that's enough to support the liquidity test for the prior 2 years. And so if you were training your new MLOs on our complete 1003 training, and you came down to the other income section, and the borrower, Joe Test, had K1 income of 2 tax years ago, 10,000. The last tax year they filed 10,000. If they had a tax return that hadn't filed yet, you'd include that amount or ask about that amount, and you would ask if any income had already been distributed year to date. And then, as they were looking through the guidelines and the discretionary topics, they would come to a discussion of this issue. So that'd be right over here. We would say for income received on a K1 from either a partnership or an S corporation Freddie allows using the income earned whether or not it was distributed to the applicant. For Fannie, if you need more income than was distributed to qualify, you must examine the entity's tax return to determine if there is sufficient liquidity to allow qualifying the applicant on the full amount of their income earned. Your underwriter may allow use of all the income if there's a prior history of distributions equal to or in excess of income earned, or they may require you to make a liquidity test of the underlying entity, and Fannie has two separate liquidity tests depending on the nature of the business. It isn't in the guidelines, so underwriter discretion could come into play, but lenders have reported calling Fannie Mae, and if the 2 years of tax returns are needed, but only the most recent one shows prior proper liquidity, is acceptable to average the income in from both years when liquidity wasn't present. And even if both years do not show the proper liquidity, but a current CPA prepared balance sheet does, they will accept using the income from both years when liquidity was not present. So again, check with your company policy if there is one on this issue. Otherwise, make sure to check it out through underwriting before you commit to your borrower that you'll allow current liquidity to count all the income that wasn't distributed in prior tax years. But this is a little known guideline or interpretation of a guideline that could definitely help you qualify more borrowers.